All right, so let's get going on this. So today we're going to kind of go through the tax law changes. I know a lot of people have heard probably some good things, probably some bad things. And so one of the biggest things that we want to go through is just, kind of take the politics out of it and just say, here's what is different. Here's what's going to benefit small business owners. Here's maybe some of the pitfalls that small business owners will see. All right, and so Reed's going to take it over from here. We got to get Reed unmuted here. There you go.
All right. So what I'm going to cover first is like an overview of the individual taxes. And then we'll try to go into the specifics of most of them. So the overview, the first item that we see here is a new standard deduction. And next to that, you could also say no exemptions. So that's the first change that we're going to see. And we'll explain what that is a little bit later. We're going to find lower tax brackets for most income levels. Guys, I think everyone's going to be excited. Lower taxes is a good thing. Increased tax credit, we're going to explain that. That's an exciting thing. It's free money. A tax credit is just like giving the government money or they're giving you the money to pay the taxes. Then there's this cap on the state and property taxes deduction. It's also known as the SALT tax. So you've probably heard that along the way. You also probably heard about the cap on mortgage interest. Those two got the most publicity along the way. We'll explain each of those and how that's going to affect everybody. A couple items that really didn't get pointed out a lot were the last two items here. Alimony. Alimony will no longer be deductible for a person paying it, and it will also no longer be taxable for a person receiving it for divorces that occur after December 31st, 2018. So in other words, any divorce that happens in 2019 going forward, if you're paying the alimony, you will no longer get a tax deduction for paying that alimony, and the person receiving it will no longer have to pay taxes. So this is our first tax tip. If you're planning to get divorced, now's the time to do it so you could get a tax deduction if you've got to pay the alimony. And if you're going to receive the alimony, put it off, put it off, put it off. All right. Unreimbursed employee business expenses are gone. Okay, that doesn't sound like it's something that's exciting and it's going to affect you, but it does affect you. Because if you really think about it, your technicians used to write off their tools, their uniforms, and their home internet. That's gone, all right? So now that they can no longer write those off, this is an opportunity for you to possibly create a reimbursement plan to them, which gives them money that is tax-free and a tax deduction for you, the business owner. It could be a nice way to shift some income that possibly shows up on a W-2 to no longer being on a W-2 and allows them to not pay taxes on the money, and you still get the same full business deduction on that, all right? So those are the highlights and the overviews. Do you have anything you want to add on those?
Nope, that pretty much covers it.
All right, so let's dive over to the difference between the standard deduction.
All right, so as we can see, 2017, we had a standard deduction of $6,350 for single and $12,700 for couples. We can see 2018, this current year, that's doubled. We're up to $12,000 for single and $24,000 for couples. Now, what does that mean? What is the standard deduction? A standard deduction is just that. If you don't choose to itemize, you can just take that deduction off of your income. So if you're a couple and you make $100,000, you can take $24,000 off your income. You're not going to pay tax on that. Now, what is itemized deduction? How does this affect me? What you have to do to figure out if you're going to even worry about the standard deduction is you have to take your medical expenses, which exceed a cap, your state withholding, your property taxes, which both of those are going to be limited to a total of $10,000, plus your mortgage interest and plus your charity. If all of those are more than $24,000 for married couples, then you can go ahead and continue to itemize. If those are less than $24,000 for a married couple, there's no reason to do anything. You just stop, take the $24,000 and move on. Same for a single. If all those add up to more than $12,000, go ahead. We're still going to be able to take that deduction. But if it's less, you're going to just take the $12,000 and move on. One of this, the objective of this was to hopefully simplify the tax code right? And simplify the tax return so that anyone can file this. Did it do that? Maybe, maybe not. You know, I think the $24,000 is a big number. With the limits on state withholding and property taxes, we are going to see a lot more people taking the standard deduction. Now, one of the things that Reed said before about withholding property taxes being limited is that that is for your primary residence and a second home, all right? So he'll get into that a little bit further, but that doesn't affect rental properties or your commercial real estate, all right? So this is just state withholding that's on your W-2 and property taxes that you're paying on your primary residence, all right? So let's take a look at this and let's see what the new tax rates are, right? Because I'm sure a lot of you people heard, or, you know, what sells on the news is, you know, this is just a tax break for the rich, right? Top tax bracket got the biggest break. We can start from the bottom and let's just look at the top tax bracket. So it's true, the rich did get a tax break, right? They're almost at 40% on their current rates, or this would be old rates. It goes down to 37%, so almost a 3% drop. But if you look at, you know, bucket 5 here, that went down 1%. Bucket 4 went from 28% down to 24%, all right, a 4% drop. Now, the biggest reason I point out bucket 4 is that's where a lot of people's income is falling in there. And that's a big thing that we're going to be able to see in your paycheck. You probably already noticed that right now.
So, Han, when you mention the different tax brackets, so does it mean when I move to the higher tax bracket, that means I pay that tax rate all the way through, or is something different? What happens?
No, and so that's a big question that we get asked a lot is they're saying, hey, I don't want to make more than $250,000, right? Because it's going to bump me up into the next tax bracket. All of these brackets, they're just that, they're brackets. So if you make up to a certain income limit, all that income in that bracket is going to be taxed at 10%. Once you go to the next bracket, anything that falls in that bracket is taxed at 12%. So if you're making $200,000 and you move from the 22% into the 24%, only the money that you make above that $200,000 is going to be taxed at the higher. Everything taxed below that is already going to be at its respective rates. But a good question, because we do hear that a lot of like, oh, you know, where's the limit that I want to not make more money so that I don't get in the next tax bracket? Not a good way to think about it. Make as much money as you can. You know, tax is also just a byproduct we can only do so much about. But like I was saying before, you know, you can see most of these brackets went down about 3%, 2%, 1%, all across the board they dropped, right? It's not just at the high income levels down here at 37%, even the second bracket, you know, went from 15 down to 12%. Some of these brackets were also expanded to encompass a lower rate at the same income levels, which we will see here shortly. All right, so let's just take a look at the single tax rates. And now what this is doing is just saying, if I made this much money on the old tax laws, what's the difference that I'm going to pay with the new tax laws? All right, so let's start off. If you made $40,000 with the old tax laws before these changes, you would have paid about $5,600 in tax. New tax laws, you're going to pay about $4,700. All right, a drop of about $900. Now, we're saying, okay, it's $900. That's not a whole lot of money. But when we're comparing it to the overall tax paid, that's a significant amount of money, right? The overall tax is $5,600, and it's going down by $900.
Also, when you think about it, if a person's making $40,000 and they're saving $900 in taxes, you're going to look at it $75 extra a month that they're going to have to do whatever they want with. So that's where the plus is. That's going to be, for a smaller income person, that's a lot of extra cash to do additional things with.
Yeah, and some of these changes are what most people have already seen in your paychecks, right? Some of the things that we'll get into later with the expanded business deductions, none of those have been felt yet, right? We're not going to feel those until we file the taxes next year. But all of these changes in the income tax bracket and income tax rates, you've already seen on your paychecks. Your employees have probably already seen on their paychecks as well. So let's see what happens when we make a little bit more money, all right? So same idea. If we're making $75,000 here, we're going to go from paying about $14,400 in the old tax rates down to about $12,400. A savings of about $2,000. If we go up to $150,000, we're going to have about a $4,000 tax savings. All right. So this is nothing other than just changing the tax rate, expanding some of the tax brackets. You can see the savings already. So let's take a look at what happened with married taxes. Married couple making $50,000, going to go down about $1,000 in tax paid. Make $150,000, pretty similar to single taxes, right? You're going to save about $4,000 there. All right, child tax credit.
All right, so the child tax credit got expanded. The old tax law said we got $1,000 per child tax credit limit after $75,000 of income for singles and $110,000 for couples. And that's for a child that is under the age of 17. The new tax law, it's still with the under the age of 17, but expanded from $1,000 to $2,000 per child. But it's more important is they increased the limit. The limit now is you could make up to $200,000 if you're single, and you'll still get the $2,000. And if you are married and you filed a joint tax return and you have up to $400,000, you're still going to get that $2,000 credit. That is a huge jump from $110,000 to $400,000. That's going to expand so many more people being able to get this tax credit. And remember what I told you, a tax credit is just like the government is paying your taxes for you. There's a new tax credit, okay, new for 2018. It's a $500 credit for dependents. And this is anybody else that is over the age of 17 that is still considered a dependent for you. It could be your child. It could be your parents that are living with you. It could be a non-working person living with you. You still could earn this $500 tax credit. So now if the kid is going to college, in the past, we lost any chance of a tax credit. Now we get a small $500 tax credit for them being in college because they are still your dependents.
All right, so we had a good question come in here. Gary just asked a question, and he said, how did the $500,000 tax bracket just save $2,000? So the biggest reason with that is you can see that most of the tax rates went down, but some of these tax brackets were expanded, right? And so where in the past we might have had a tax bracket where it was in the 22% tax bracket, you know, this year it might be at the 20%, but it might be for a smaller amount of money. So what we will see is when you get into that $250 up to that $500,000 range, more of that money is going to fall in a higher tax bracket. And so you don't see that overall savings as much as you do in the smaller income levels. And then, Jamie, I see you asking a question to see the tax bracket for married one more time. We're going to move on from that, but shoot me an email and I'll get you this slide so you can take a look at it, and even ones that'll show the brackets a little bit better as well. All right. Go ahead, Reed.
Just to give you an idea of the expanding of the tax brackets, the old tax bracket that was 28% was from 152 to 232,000. The new tax bracket that is 24% goes from 165 to 315,000. So once again, more dollars are taxed at 24% instead of 28% under the new laws. So those are how it'll expands out and it gives to us to our benefit. Okay, let's talk about the SALT tax. All right, so we have our limits on some itemized deductions. I mentioned before the SALT, the state income tax and property tax is capped at $10,000. Hunt also shared about that. A lot of publicity. If you're in a state such as New Jersey, New York, California, where you have high property taxes, sorry, this is going to be a hit on you. It's reality. The states are trying to do some workarounds on it, but at this point in time, you're going to be capped at $10,000 deduction for your state income taxes, your property taxes. And as Hunt mentioned, that's your property taxes on your primary residence and a second home. Now, your property taxes on commercial property or rental properties per se, we're still going to deduct those fully on your rental schedules. All right, so you'll still be able to deduct the property taxes on the business stuff 100%. That's not being limited at all by this $10,000 number. The government had in the past $1 million limit for mortgages. That limit for mortgages is continued on. It's grandfathered in, But any new mortgages, now the cap on the interest is over $750,000. It stops. You get to not deduct the interest on that. So under 750, you will be able to. Over 750, you won't. You got to watch for refinances and stuff like that. The other big question, or the big item we've heard, is you will not be able to deduct home equity interest. Well, that's not true. You still will be able to deduct home equity interest on loans as long as it's for improvements. All right, where you used a home equity loan to buy a car, to take a summer vacation, to pay off credit cards, that interest will no longer be deductible, okay? But still, if you do improvements with your home equity, that's fine, as long as the total mortgages on your property are less than the 750. All right. Entity tax returns that were filed in the year 2016. We have, because we're going to now start switching gears and we're away from the individuals, we're going to start talking a little bit more about businesses and the tax law's effect on the businesses. So these are business type tax returns. We got a Schedule C. That could be a single member LLC or a non-LLC, which is our largest type of tax return that is a business type of tax return. 25 million of them were filed. There were 4 million partnerships, there were 4 million S corporations, and there was 2 million C corporations. What I want you to do is add up the Schedule C, the 1065s, and the 1120Ss. Add that together, 34 million tax returns. Just remember that, 34 million tax returns. You're going to hear that number a little later. So let's talk about an overview of what's new for businesses. All right, so our overview for what's new with businesses is we now get 100% bonus depreciation available for most new assets up to $1 million of new assets placed in service. The old law was up to $500,000 worth of new assets. Now, for all of our repair shops and body shops, it really doesn't affect most of them because most of our clients never spend even $500,000 on equipment unless they bought a new tow truck. That would be about the only thing, or a few new tow trucks that would bring them over that. But also I need to tell you that something's important here is that the bonus depreciation may not follow state tax laws. This is just strictly for federal. So Hunt, what does this now mean that we have a different depreciation for states and a different depreciation for federal? What this means is we finally could keep two sets of books, okay? One set of books for state and one set of books for federal tax law. Not those two sets of books that some of you other people might be having. All right. Trade-ins on new assets. Trade-in on new assets are now going to be treated as sales. That deals with assets that are like used in business, not necessarily real estate. I'll explain that a little bit later. No more entertainment expense deduction. The 20% deduction for pass-through income, we're going to spend a lot of time with that. We're very, very excited about that. You're going to see the great benefit of that. And the flat 21% rate if you are a C corporation. In the old law, you paid 15% on the first $50,000, 25% on the next $25,000, and it kind of went up from there. Now it's 21% from $1 of profit going forward. We're going to explain if that's a good thing or a bad thing. All right, new section 179. There are new items that qualify. This is also good for us as small business owners, is now we get to write off improvements, our new roof. In the old days, our roof would have to be depreciated over 39 years. Now we get to write it all off in 1 year. Our HVAC, anything else like alarms, anything of improvements to the property, with the exception of a brand new building is going to possibly qualify for the 179 and writing off as a leasehold improvement. For rental properties, the nice thing here is now we don't have to depreciate refrigerators, washers, and dryers, and little things like that.
So one of the things I just want to add in here about that is this is qualified leasehold improvements. And so Laura Frank, would repaving the parking lot qualify for 179? Yes. And so that's exact example of one of these things that in the past was not able to be deducted. And we had a lot of our clients to us and saying, hey, you know, we just went over our tax estimate like we do with a lot of our clients and saying, you're looking at, you know, maybe $40,000 due at the end of the year. And there's major capital projects that they wanted to do on their shop. But if you're taking that over 15 or even sometimes 39 years, the bang for the buck really just isn't there, right? If I'm going to go out and spend $80,000 on a new roof and I say that's fine, but you know, old tax laws, we're doing that over the life of the building at 39 years, you're probably not going to be too happy to get that small write-off every single year. With these new tax laws, you go out there and you pay for that new roof, we'll get the dollar for dollar deduction today on that, right? The only thing that we got to keep in mind that we got to be, you know, a little bit aware of for one side is the little bit of a trap here is if you're paying a loan for this stuff, you might want to think about maybe not doing the full 179, right? Because we're taking all of the expense today, and if you're paying a 7 or 10 year note on that, you'd still need to pay that for 7 or 10 more years with the profits of your business with no corresponding write-offs for that, right? And so that's one thing to think about. We don't always write it off on the first year. We'd at least like to educate our clients on, hey, you know what, you could get into a trap if the business trends down a little bit. You could be showing profit, which the profit is only there to pay your loans, and now you have no cash to pay for those profits, the taxes. And so then the next thing we got to think about here is just like what Reed said before, this is all federal rules, right? And so a lot of times I have people saying, hey, we made $250,000. Great. We went out and bought 2 new tow trucks. We are going to be able to write all of that off. I'm not going to owe any tax. But some of you obviously live in some pretty high tax states. Some states recognize no accelerated depreciation. And so you could have a situation where you're paying no business income, right? For federal, the 250 is completely wiped out with the 179, but you're paying $250,000 or you're paying tax on $250,000 for your state. So just keep those 2 things in mind.
Like-kind exchanges, all right, effective January 1 of this year or December 31st of last year, the tax-free exchange will be allowed for real estate only. So personal property items, i.e. your truck or equipment, when you trade those in, those trade-ins are just going to be treated as a sale, all right? So it's just like you sold the truck that you traded in and they gave you a $10,000 trade-in value, you sold that truck for $10,000. If we completely wrote that truck off, you're going to have $10,000 of income. Now, 9 times out of 10, my clients are going to be trading a truck in and getting another truck, so we'll get the full write-off of that new asset. As we see at the last line there, purchase of the new asset will be at the full price, including the trade-in for the credit or for the full bonus. So you'll be able to write some of those things off along the way with the new asset having a higher value. The old laws basically said the trade-in used to reduce the value of the depreciation, the new asset. All right, 6 1/2 dozen another, we should be okay. I think the only problem we're going to have is if you trade in a pickup truck, you got $10,000 for the pickup truck, and then you buy a car versus another truck, you may not be able to get as much depreciation out of that car as you do with that new truck. Let's move on to meals and entertainment. So again, starting this year, entertainment, amusement, and recreation no longer is deductible, not even 50% of it. So if you take somebody to an athletic event, you pay your dues for the golf club, you buy tickets to a show, everything relating to that entertainment gets a 0 deduction. So you will probably, I would recommend that you take the word entertainment off of your QuickBooks file because entertainment has no place as a deduction for you. All right. Now your meals, you still get 50% of that. All right. So you still could take people out to eat. You just can't take them to something fun, okay? And you still get 100% for your meals if you are providing food to your customers or having meetings on site, all right? So the big thing here to remember, entertainment is gone, all right? You may need to find somewhere else to bury that, but I can't tell you where to bury that. Pass-through business income deduction. The deduction is up to 20% of your profits. Let's relate this. So therefore then, you make $100,000, you only have to pay taxes on $80,000 of it. Can't get better than that, all right? That's $20,000 we don't pay taxes to. And if I mentioned earlier, Schedule C qualifies for it, partnership income qualifies for it, and S corporation income qualifies for it. All right, that's the Schedule C, the partnership, and the S corporation. I told you to remember a number: 34 million. That means 34 million tax returns that are going to get filed, and if they have a profit, 20% of the income most likely will not have to be paid taxes on. The other thing that's really exciting for my clients is your Schedule E, okay? That's treated as a trade or business. So therefore, if you're doing a self-rental and you own the real estate and you rent the real estate to the shop pays a rent, that real estate makes a profit. Again, we'll just say it makes $10,000 profit. You're only going to pay taxes on $8,000 of it. So $2,000 of it along the way, we don't have to pay taxes on, all right? Schedule F, most of our clients don't usually show any profits from their farm, so it's there, but if you do have a Schedule F and it shows a profit, we don't have to pay taxes on 20% of it.
And so Debbie reached out and said, this is great. And so we will agree. I mean, this, I would say they're the two biggest things that we're going to see when we did our tax estimates. It's helping our clients the most is obviously this 20% deduction on any sort of business income. All right, that's going to be a huge saver there. And then the other thing is going to be the child tax credit. Between those two, those are the ones that we're most excited about. And we'll kind of we'll go through some examples and show how big of a difference this makes here in a second.
C corporation issues. It used to have a graduated tax rate. It's now a flat 21%, okay? The disadvantage of a C corporation, it has double taxation. I'm also going to say as a disadvantage, that 21%. I just went through a tax estimate we have very, very few C clients, but I went through a tax estimate with a client of ours that's a C client, and in the past, he would always show about $10,000 profit, okay? In a C corporation, he would pay $1,500 in taxes. I went through that same estimate with him. He's showing him making $10,000 profit again. He's now going to pay $2,100 in taxes. He got a $600 tax increase by being the C corporation because from $1, they start taxing at 21%. Truthfully, the C Corp benefit of the 21%, that's going to be your Coca-Colas, your IBMs. They really benefited from it. For Ma and Pa like you and I'm really thinking that why should you stay a C corporation? There's no benefit at this point in time because there was some benefit with the concept of the 15% bracket being lower than the individual. Now the lowest bracket and the only bracket for a C corp is 21%. The lowest bracket for an individual is as low as 10 and 12%. So I rarely would think that it's not overly advantageous to stay as a C Corp. Hey, Hunt, why don't you go give some examples of the benefit of this 20% reduction deduction?
Perfect. So one more thing on the C corporation is I know a lot of people have been saying, well, you know, your highest tax bracket is now 37%, but C Corp caps out at 21%. But we see the first disadvantage, that's double taxation. So you pay the 21% on the C Corp earnings, but then now you have to get that money out. And so you're either going to have to leave it in the business, or you're going to have to write in the form of a dividend, which is going to then be taxed at capital gains, which is another 15%. Now we're already up to 35%, and you're saying, well, Hunt, that's still lower than what we were having before. No. Why? Because we have that 20% deduction for everything other than C corporations, right? And so just like Reed said, we've done a couple different situations to see, hey, does it make sense to switch C Corp or S Corps back to C Corps if they're high income earners? We haven't seen a case where it makes sense. Another thing with C corporations, if you are to sell it, that money's trapped inside the business. It's going to bring up a lot of issues there. So really, the only reason we see a C corporation right now is if you have carryover losses from people before or from years before, or if you have an issue with your ownership where the person operating it is not the actual owner of it. All right, so let's get into some different examples here. So first one we're going to take a look at is a single person with a Schedule C. All right, so not married, has a Schedule C. Let's just say this guy has a shop, makes about $100,000 a year. All right, obviously we got no W income because he's just a Schedule C. He's not on payroll. All right, so he's going to make about $100,000. He's got his standard deduction and exemption, so that's going to lower it down. Taxable income about $89,000. He's going to pay about $30,000 in tax. Now, if we look at this year, same income, $100,000, but you can see that 20% deduction there. So automatically, he's already down to $80,000. New standard deduction up to $12,000. So now he has actual income of $68,000. He's going to pay tax of $23,000. Tax savings about $7,000, right? Pretty good. All right, hang on, Reed's got it.
All right. If this guy was all W-2, so Joe Smith is the W-2 earner with $100,000, he would end up saving $2,500 in taxes because of the tax rate reduction. All right. So this 20% reduction really helps out big dollars from $2,500 up to the $7,000 in tax savings.
Yeah, and that's how we get from that one of the first slides that I showed you guys where the tax rates are just going down and what you've already seen in some of your paychecks. Overall income earners, W-2 earners, they're getting a break here. But the biggest thing that we're excited about is these are truly tax breaks for small business owners. This is stuff that our clients are seeing. I know I've done some tax estimates where I have people that are saving $40,000 to $60,000, right? It's pretty big, and we're very excited about that. So let's take a look at an example of what most of our clients are here as an S corporation, right? And so we got W-2 income because as an S corp owner, you got to take a salary. And then we have $75,000 an S corp and LLC income, whether that's just an S corp or maybe he has an S corporation, also has a rental LLC, but between the two, they make about $75,000. So all in all, we got $150,000 of income here. We got this guy's exemptions and deductions. Now his taxable income is down to $139,000. He's got tax of $32,000. All right. Again, this is a single taxpayer, no kids, just a S corporation and his W-2. So let's take a look at 2018. Again, same income level. We got that 20% deduction for qualified business income, which is going to lower it down $15,000. Standard deduction of $12,000. He's going to pay tax of $23,000. All right, tax savings of $8,200. 25, almost 30% tax decrease there.
So, hon, I noticed he's taking a W-2 of $75,000, and I recall you came into my office the other day talking about a new article that you're doing. Do you want to tell them about the article that you're going to be putting out and sharing with everybody?
And so one of the big things that we get asked is, what should I be taking as payroll, right? Because as you can see, we have a 20% or 20% deduction on S Corp's partnership Schedule C income. None of that 20% goes for W-2 income. And just like Dawn is asking right now, you're exactly right. Is it better to lower your W-2 income? It is. But what you'll see, I'll post this article in a couple of days. There's a couple of things we got to keep in mind. And so this new tax law that came out really shifts the incentive to take almost no W income, right? Just leave it all in your S corporation. That way you're getting a 20% deduction. Now the pitfall to that is, one, we got to cover ourselves for the IRS. What does the IRS say? If you're an S corporation, you got to pay yourself a fair and reasonable salary. What is that? It is whatever you would have to hire someone to do your job. The next thing that we got to think about too is Social Security. I know hopefully, you're going to use Social Security benefits when you retire for what they are, supplemental benefits. But if you're going to be playing around and you're not going to take a salary at all, you could end up retiring and have benefits of, $800 or whatever the minimum is now. What we're saying as a general rule of thumb is around $60,000. $60,000 usually passes the smell test, and $60,000 is going to give you a good pay into Social Security. It's obviously taken over your 35 years of highest earning years. So if you've been messing around with this for a while, you've been taking no payroll, then you know what? You don't need to be at $60,000. You maybe need to be closer to $100,000. All right. Again, every situation is a little bit different. We can play with that a little bit, but it's a good rule of thumb to start there. Yeah, so we'll get that posted out here in a couple of days. Good question here. All right. So let's take a look at a family. Remember what I said before, the two biggest things that we're excited about here is this 20% deduction for small businesses and then the child tax credit, right? So let's take a look at how that child tax credit is going to make a difference. So this is a married couple here. Again, just like before, we got a W-2, we got LLC, S-Corp income. All in all, we got some deductions for the kids and themselves. We got taxable income of $121,000, tax of $21,000. Now let's look at 2018. Again, same income. We got that $15,000 deduction there for qualified business income. You can see the exemptions and deductions actually have went down, right? Because exemptions are gone. There's no personal exemptions anymore. It's been replaced by the expanding child tax credit. So our taxable income is still lower. We're paying tax on $111,000, but take a look at that tax, $12,000, a difference of $9,000. And so what's the big difference here? So we got two things. In 2018, we got that $15,000 deduction along with the lower tax rates and the expanded brackets, right? So that's going to save him some money here. The biggest reason, in 2017, that $21,000 tax where it says tax after tax credits, he has two kids. In the past, what was the deduction for two kids? $1,000 per kid. But he made too much money. This couple made too much money. They got no tax credit. Now, since the tax credits have been expanded for 2018, not only did they get an increased tax credit, they got $4,000 of child tax credit, but the income limitation, it doesn't start to phase out until $400,000, right? So not only are more people going to be able to get this tax credit, it's also going to be a lot more beneficial as well. All right, so Roger, we got a question here. He says, I've been taking $50,000 as W-2 for years. Should I raise it to $60,000? And so what we'll say about that is the reason we say $60,000 as a general rule of thumb is $60,000 is roughly the top of one of the big brackets for Social Security benefits. All right. And so as you pay into Social Security, you can keep on paying into Social Security up to $128,000, but it's the law of diminishing returns, right? Once you get above $60,000, you're still getting more Social Security benefits in the future, but it's going to be less and less for what you're paying into it. All right. You should begin in the statement that's going to say, hey, your wage base or your taxable Social Security base is this. Right now, if you had, it's going to be adjusted for time, but if your average is $60,000, it's going to get you about $2,000 in Social Security benefits in the future. So we can work on that a little bit more, Roger, but you're pretty close there. Good questions here. So let's take a look at the same scenario, but this couple's just making more money. All right. So we can see $125,000 of W-2 income, whether that's one of the partners making more money or making $125,000 on W-2. Maybe they want to max out that Social Security, or maybe they're both working. They're both taking home about $60,000. Either way, between their W-2 and their S-Corp and LLC income, they have about $300,000. All right, just like before, the exemptions and deductions are going to be about $29,000. Their tax is going to be about $66,000. 2018, again, income's not changing at all. We're going to still have the same W-2, same S-Corp income, but we have a 20% deduction on that. We're getting a $35,000 deduction. Just like before, the exemptions and deductions are going down a little bit because those personal exemptions are gone. But still, taxable income is only $241,000. So right off the bat, we're paying tax on $30,000 less than before. Tax after tax credits, because again, this couple in 2017 is getting no child tax credit. 2018, they're getting $4,000 child tax credit. Tax savings of $24,000. All right, so that's huge. I mean, this is what we are really excited to see. Some of the smaller ones, you know, I've seen $6,000, $8,000. That's good. You know, this is really a big change for a lot of people. And so one of the caveats here, I know Reed's got a couple of things to add on this that I'll say is we, you know, put a couple examples in here about what could happen. Have we seen scenarios where people have been negatively affected by this? Yes. Are they few and far between? Yes. When people ask me about this, hey, how is a new tax law going to affect me? I say generally it's probably going to have no difference to a positive impact. I've only seen very few where it had a negative impact, and if it did, they really about stayed the same. But if you're in a state, you know, a perfect example, I had a client in Florida, right? So they have no state income tax, so some of that limitations is there's no negative to them, and they make a bunch of money with their business. They were going to save about $60,000 this year. Now, unfortunately, for Reed and myself being in Maryland, we get hit with a double whammy, high income tax for our state income tax, and also high property taxes. So again, you know, some states win, some states lose, but that 20% deduction for small business owners outweigh most of those downsides there. All right.
So this $23,900 in tax savings, that works out to $2,000 a month in cash savings that you would have. So I hear many of you saying, Reed, I don't have any money to put away for retirement. I don't know where the money's going to come. This is $24,000 that you could be plunking away towards your retirement account. Hunt mentioned the idea of Social Security. It's supplemental retirement. You need to be thinking about yourselves. So some of these tax savings, I really would love to see you reinvest in yourself, put money back into your own retirement account if and when you see these tax savings. If not, at least work on reducing debt. At least do something smart with this money. I know almost all of your employees looked at this extra money in their paycheck and they said, oh boy, another six-pack, okay? But I want you as business owners to be smarter than just your average employee. I want you to be able to think about, hey, this extra money, I'm going to start putting away for my retirement. I'm going to benefit myself down the road. I'm going to get rid of some debt to make my life a little less stressful, all right? Examples I have with some clients along the way, I went through one example, and the client's going to make $360,000 more money. On that $360,000 of additional profits, they're only going to pay 19% taxes on that money. I mean, so with a change of the tax brackets and that 20% reduction, they're not paying that much dollars out in taxes. Another one where it was $160,000 more profit this year than last year, they're paying 9% taxes on that new monies, okay? So therefore, they're only paying $15,000 in taxes on $160,000 of income. You know what that means? They got $145,000 in their pocket because of the new tax laws and the lower brackets. The best one I have is client made $120,000 more money this year, and they're going to pay $20,000 less in taxes than they did last year. Okay, that is the cool thing about the 20% reduction, the new tax credit, the lower tax rates. The ones that I've seen as a negative impact on their taxes are almost everybody that's only a W-2 earner. So if you're taking all of your money out of your S corporation in a form of a W-2 and not letting some of the profits come through, you're definitely not, you're going to be one of those people that may feel an increase in taxes. So those are things you got to, understand. Most of us as business owners are definitely going to benefit by the 20% reduction deduction. By the way, I do want to thank Hunt for taking the time to set up all these slides and being our our AV person and everything else. So hopefully everybody that has been listening in on the webinar has gotten some good information. Most of you that are our clients have already felt the tax implication as we've gone through your tax estimate with you.
Yeah, and so like I said before, I think someone requested that they wanted to see this bracket. Just shoot me an email. This email, if you have Reed or myself's email already, you can just send it to this. This info@parmelis.com just goes to both of our emails together. So if you want to have us both on something, send it to that. Take a minute here. If you have any other quick questions that come up, you're welcome, Laura. Thanks for joining us. Let me know if you have something that's specific about your business. Just shoot us an email so we can go through it a little bit more in depth. We hope you guys enjoyed this. It's something that we will want to go over, probably again later on the year if we have any changes that come up. Hopefully we're crossing our fingers that there's no changes, but the IRS always likes to surprise us. If you have any questions or if you have any recommendations on webinars you'd like to see in the future, let us know. Or even if you just have some feedback about this or what you'd like to see differently. Yeah, so let's see here. I got a couple questions and I'll let you guys go so you can go eat lunch or eat breakfast if you're on the West Coast. Reed, will you go over this with our 20 groups? Yes, he will, Denise Stanley. Monique, will this be on the website? So yeah, we're going to get this up on demand. So we were recording this whole thing. So it's either going to be on our Facebook page and or on our website. So yes, it'll be up there. And then Michael, so LLC versus S-Corp pros and cons. So it's a little bit tricky there because most of our clients, we recommend them being an LLC taxed as an S corporation. All right. So if you're an LLC, you have the opportunity to be a sole proprietor, a partnership, or an S corporation. All right. You can do whatever you want. 99% out of the time, if you're making a good amount of money, it makes sense to be an S corporation, but shoot me an email. We can kind of get into that further. Chris Murphy, how are leases changing truck payments? So if it's a lease to own type situation, it's not going to have any difference. All right. If you are taking ownership of that or if it's extended lease, it's going to be treated just like a loan. We'll be able to write off the whole amount of the trucks. If it's an operating lease, it's going to be treated exactly the same as before, Chris. All right. So Dawn, if I pay my guys' tool bills, can I deduct the expense and they don't have to? So this is kind of what Reed talked about with a tool reimbursement plan. So yeah, if the guys come in, he's getting reimbursed for tools that he's using for the purpose of the business, we are under the impression that that is okay with us. One of the things that we did see is that you can't set up an official reimbursement plan for tools. So it's got to be more of an informal thing, but something that we think falls under the threshold of anything that could get looked at and a positive benefit for everyone involved. So good question there, Dawn. All right, so this was awesome. Thanks again for joining us, guys. Reach out to us if you need anything. If not, have a great day, and we will talk to you guys soon.